So after having the East versus West discussion, which wound up to a significant extent discussing how can Greek ship owners primarily access Asian and primarily Chinese bank debt, given that the two universes may to some extent speak different languages. I guess my presentation has a similar tilt, which is how Greek ship owners or other private ship owners, not necessarily just Greek ship owners, can work with private equity. The points that were down on the agenda are about target returns. Are they achievable? What are the requirements to successfully attract private equity? What private equity doesn't like? Private equity exit strategy and timing, and then recent track record for recent private equity deals. I'm going to focus on points 2 and 3 because I think those are the most interesting ones, and cover to some extent, not necessarily in this order, the other points. So, well, first of all, before we go into target returns, the topic was overall what attracts private equity to shipping. I think the answer is quite a simple one. Today, shipping may very well present a once-in-a-lifetime opportunity, given where asset values are very low by many measures. At the same time, when very differently from previous shipping cycles, we actually have growth prospects in many shipping sectors, not all shipping segments, but we think at Tufton that dry bulk products and gas have very good growth prospects. That's something that we haven't really seen before in previous shipping cycles. So that means that all else being equal, and I'm not saying everything else is equal, but all else being equal, this shipping cycle, at least in certain segments, has prospects to recover from bottom more quickly than some other previous strong downturns like those in the late 70s, early 80s. A lot of private equity has also been interested in eco-vessels. We can have a whole separate conference about eco-vessels. Will they deliver? Some people believe they will. Some people believe they won't. I don't think that's a topic for this forum, but clearly it's a topic that is very key to the industry and one that has made private equity quite interested in the sector. Consolidation being likely as well is another thing I think that makes this cycle more interesting for private equity than previous cycles, because shipping historically is a highly fragmented industry. Over the past 10, 15, maybe even 20 years, we've seen a lot of consolidation. There's more to come. More is needed, and it's likely to come in this cycle. It's already started, obviously. That only explains why private equity looks at shipping. It certainly doesn't mean that private equity will invest in shipping. And there are a couple of reasons for that. And one is that what we generally, or the mainstream press and shipping press, lumps together private equity is actually a very diverse group of professional investors who look at investments very differently. So while some of the traditional private equity houses, which are more oriented towards leveraged buyouts, those houses have been not very active in shipping. We've seen others that historically have been more interested in cyclical industries. We've seen them more active. Another thing that's very important to remember as well is that for private equity, you have to compare the opportunity in shipping to other opportunities that are around. Not for Tufton, because we're only active in shipping and energy, but for the generalist private equity firms. To the extent that other industries are not presenting opportunities they're as interesting as they may have in the past due to macroeconomic concerns in the US, macroeconomic concerns in Europe, then maybe shipping, which has a significant exposure to emerging markets, that's become more interesting as well, whereas historically it was not due to the cyclicality. Target returns, are they achievable? That's very difficult to answer. Certainly, we at Tufton and all of the private equity firms and all of the very clever Greek private ship owners who have been investing in shipping over the years believe that high target returns are very achievable. Private equity tends to target 15 to 20% net returns on equity, or looked at another way, we're looking to double our investors' money in 4 to 5 years, which is mathematically those are the same. In order to generate those returns without expecting the uplift of an IPO exit, generating those returns does mean that you have to expect a material capital appreciation in vessel values over the next 4 to 5 years. That is not possible in all market segments. So if you have a 4 to 5 year horizon, that will drive you towards investing in certain segments and drive you away from investing in other segments. So we do think that you can double your money, double your investors' money after fees, etc., in a 4 to 5 year horizon in certain segments. Gas is one. Products definitely, in some segments of dry bulk, and those are the sectors that where we've been active. So they are achievable, but not necessarily in all segments of shipping. Not today, anyway. In 2 or 3 years, you may be able to double your money in Cape sizes over the next 5 years. But I don't think anyone thinks you're going to double your money in Cape sizes if you invest today. So, what are the challenges for a private ship owner in sourcing private equity? The key thing for private equity and most other professional investors as well is alignment of interests. Is the private equity firm or private equity investor and the ship owner, do they share their objectives completely? Are they both in the front seat of the car? Private equity doesn't like to be in the back seat. They normally like to be in the driver's seat, but they can occasionally be in the passenger seat, provided that they're in the front with the ship owner. So some of the points to think about in terms of alignment of interests are: is the ship owner contributing cash, especially new cash, or is he contributing vessels? And if he's contributing vessels, at what values is he contributing those vessels? Obviously, the preference is that a ship owner is contributing new cash alongside that of the private equity firm. Where in the corporate structure is the money being raised? Is it being raised at the vessel level? Is it being raised in a portfolio of vessels? Is it being raised in the top company that also includes commercial and technical management? And I think there isn't necessarily a right answer, but different firms have different preferences. We at Tufton actually like to invest in vessels. We don't necessarily need technical and commercial management to be part of the package, other than that they need to be provided to us on good terms. Use of proceeds. What is actually happening with the new cash? Has it been identified for new builds? Is it for second hand? If it's for second hand, are the deals that the ship owner plans to do, are they actually feasible in the next few months? Are they feasible next year? We've seen a lot of deals where people want to buy 10, 15-year-old handy-sized bulkers for $10 million, charter them out for $11,000, $12,000 a year. That's a great deal. But normally when people have pitched those deals to us, it's not a deal that you can actually execute at the time, although you may be able to do that Today, you weren't able to do that 18 to 24 months ago. Governance and managing conflicts of interest is extremely important. There has to be at least joint decision making over key issues like selling of vessels, acquiring vessels, IPO exit potentially, refinancings, and approval of related party transactions with other parts of the ship owning group if those are relevant. So technical and commercial management fees have to be competitive. They have to be benchmarked against international standards, and obviously you have to they have to be provided at world class quality. Due diligence requirements. I cannot underestimate or I can't overestimate what the very stringent due diligence requirements of large investors are. They are experts in crunching data on any market. So, they've spent 15 years dissecting the casino market. They want reams, gigabytes and gigabytes of data on shipping. They, sometimes it means they ask for, can I have a 50-year history of what time charter values are on a VLCC? Well, that one's a little bit difficult because there weren't that many VLCCs around 50 years ago. Same thing, can I see 50 years of data on 8,000 TEU container ships? No, you can't. But crunching data is something that's very important, and their use of professional advisors comes at a cost, but it's part of their DNA to do deals in this way. The last point I wanted to bring, cultural fit is obviously a key, but that's largely encapsulated in the other points that I've mentioned. But advisors and brokers is another key area, because I think what a lot of people find is that the types of advisors and brokers, including big investment banks, that the private equity firms would tend to like to use, really have a very superficial knowledge of shipping. And the advisors, brokers who ship owners would tend to like to use, very good research people at some of the either research houses or ship brokers who really do know the market well. Although they do know the market well, they can't really help make the connection between the ship owner and the private equity firm because they don't understand how the private equity firm or the investment banks work. So this is a challenge, but one that's obviously been overcome in a lot of the deals that have been announced recently, and some of the deals that we've done. One thing that we found as well is that actually, while ship owning groups often look to raise private equity, the actual fit that is better for private equity is actually for them to hire or to back or sponsor a small management team that may have worked together at a shipping company. That much more fits the traditional private equity model. Private equity likes to back a management team, especially the big leveraged buyout firms in the U.S. So that is a much better. That's a much better fit. The other point on the question list was what private equity doesn't like. So let me go through some of those. I've also called these are the challenges. So the other points were, what are the challenges for the ship owner? What are the challenges for the PE investor or fund? Cyclicality. That was a point that was brought up in the previous panel. Shipping is very cyclical. That's traditionally something that most private equity houses don't like. They like stability. They like an asset that you can throw a lot of bank debt against based on cash flow as opposed to based on asset backing. And in shipping, and especially in Greek shipping, a lot of money is made by timing. And that's also something that private equity is not used to. They like to squeeze costs, enhance revenues, find synergies between different companies in their portfolios. For some of them, culturally, it's very difficult to invest based on primarily on timing. Unlike real estate, where private equity has been historically very active, ships are heavily depreciating assets. The mix of a steel structure with salt water is not one that is necessarily positive. Ships can last 25, 30, even longer years, but obviously buildings, hotels, casinos can last a lot longer than that. So if you get your timing wrong, you have a depreciating asset. That's a difficult mix. Poor reputation of the industry. I think that's one that's gotten a lot better over the past 10 or 15 years, but I've come across a few investors who say, the numbers look great to invest in shipping, but one of the members of my investment committee invested in some high-yield bonds in the late 90s. He'll never invest in shipping again. So that's something that is quite difficult to argue with when it's an investment committee member. Aligning interests, we touched on before in governance. These are just the mirror image of what the issues are for the ship owner. How can a PE fund add value in shipping? That's another challenge, because private equity firms go around to pension funds, universities, charities, foundations, sovereign wealth funds, with people that are experts in food and beverage, people that are expert in technology, people that are experts in healthcare, and they talk about how they add value by putting these very senior people on the boards of companies that they own. That's not something that most private equity firms can say that they can do in shipping. And in shipping, again, you make a lot of your money through timing, you make it through client relationships, but you don't really make it by squeezing OPEX by 2 or 3%, or cutting commissions here and there. Those things are great, but they really don't make the difference between a good investment and a bad investment. And then exit as well. Private equity, which we'll come to as well, has historically been very focused on IPO exits. IPO execution risk is very high in shipping. As we know, it is likely to come back. We understand that there are quite a few companies active in products and active in gas that are looking to come to market later this year, and those are probably two sectors where the markets may be open. Having arm's length fee arrangements as well between the jointly owned vessels and the ship owning family is very important as well. These things are very easy to benchmark, so it's very difficult to. You can try to get away with an off-market transaction. I guess people are able to do off-market transactions in the public markets, unfortunately, but in the private market it's actually much more difficult. If you're sitting across the table from some of the smartest guys in New York, telling them that OPEX should be this, or commercial management fee should be $300,000 a year, they will have a lot of comparables showing why that isn't the case. So that's a very, 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 very key point as well. Alignment of interests. They want to work. We want to work with ship owners who want to make money by owning the assets, not ship owners who want to make most of the money by running the assets for us. Private equity strategies and timing. IPO is still quite important, but I think whereas historically the bigger leveraged buyout houses effectively needed an IPO because that was something that they had pitched to their underlying investors, that's no longer the case. The private equity houses, due to the change in the landscape, that bank debt for large buyouts is more difficult to come by than it used to be, and because they're seeing more opportunities in commodities, natural resources, emerging markets, rather than just buying OECD consumer businesses, healthcare businesses, then the industry has become more flexible. They still would like to have, and we would like to have, IPOs, because that generally is value accretive, but it's far from necessary for investors like Tufton, and it's a nice to have, but not necessary for most private equity houses, although some still need to see a pretty good roadmap to an IPO in order to invest. The last point I was asked to address is a somewhat tricky one. The recent track record for select private equity investments in shipping. It's difficult for a couple of reasons. One is, as we often say, private equity is private. It's called private for a reason. There are people who, both within shipping private equity as well as general private equity, like Wilbur Ross, who like to go to a lot of conferences, talk about deals they've done. You don't often actually hear, although we say, Wilbur Ross says, other people say, we're quite happy with our investments. That's about all you'll actually hear. Part of that is regulatory, in that if you talk too much about your own deals, that can be considered general marketing to the public, which certainly in the US and in London and other places can get you into a bit of trouble. So people don't talk about their deals for a number of reasons. The other thing as well is that shipping and the shipping private equity deals that have been done, especially over the past 3 years, are very different. So performance of recent private equity investments, I guess we all have to accept, they'll depend on the market segment in which the deal was done. I think most people who invested in product tankers, gas tankers, will be happy. Anyone who bought bulkers in the false dawn of 2010 will be unhappy. Most people who invest in crude tankers, unless they have some very good charters, are probably pretty unhappy. And of course, the price that you paid for a deal is a key point as well. Even people who invested in product tankers, they should be happy. If they invested a year too early, they're probably not as happy as they could be. Those were my prepared remarks. I'm happy to take questions now or during the panel or after the panel.
Maybe we'll do the process of the framework of the panel. But sure. Thank you very much for the presentation. And can I invite you to join me? Can I also ask Anthony Geropoulos and Symeon Pariaros to join me? So as to further expand. Right, well, thank you again, Paolo, for this presentation. I think you set the frame for the discussion to follow, and you described what private equity likes and what it doesn't like. Going a step back, Greek shipping has been familiar with the concept of private equity, not in the form it takes place now, but each captain and his nephews and his cousins and his friends in the island was obviously active in sort of primitive private equity. So the concept itself is not too far from the way of thinking of Greek shipping. So hopefully we'll see some more of this activity going forward. But do you think, and I would be looking forward for all three of you to answer this question, do you think that this is indeed the time for private equity to step in a bigger way? Do you think that we've already seen, a few examples we've seen already of private equity, is the bulk of the deals that we will see in this cycle? Do you think the best is yet to come? How do you think we're positioned? In what part of the cycle we're positioned right now? Okay. Yes.
Works now. Okay, great. Hi, everyone. What we are seeing is a natural evolution of capital flowing in and out of an industry. And the evolution is that, when public markets are open, it means that public markets are usually more momentum driven, so as opposed to value driven. So it means that the cycle is on a sort of on a recovery. Then when the public markets dry out, usually it's because there's distress in the sector. Shipping is one of the very few sectors that haven't recovered over the last post-Lehman, and actually have been in distress the last, let's say, 3 years on average. So as a result, we've seen this natural flow that any industry experiences, which is that private capital is coming now, that the investment is more of a value proposition as opposed to a momentum proposition. It's indicative of what we used to say in the good years when the public companies were very active and companies used to go public, that now the shipping has emerged as a quote-unquote space, meaning a new sector in the capital markets. And by the capital markets, I mean broadly defined private as well as public. So I think there will be more transactions. I think the terms of these transactions were very well described by the previous speaker. And we will see eventually, when the market recovers, slowly these funds will be exiting the sector.
I have no doubt that we are still in a pretty early phase of private equity interest in shipping. Unless we see a very, very strong recovery in the next year to 2 years, which I think, and we at Tufton think, is pretty unlikely in most market segments. Private equity is going to be here for quite a while. In private equity as well, you tend to have early movers and you have late movers. Once one or two large firms have done deals in the space, of course, the other firms then think, although we hadn't considered shipping to be interesting, it was too cyclical, has a bad reputation, oil spills, there's pirates, these sort of things. These guys don't want to miss out on an opportunity because the underlying investors for most private equity firms are also very similar. So when private equity firm 7 goes out to talk to its prospective investors about what its strategy is, of course, if private equity firm 3 that was in there a few weeks ago talking to them about how they're going to make money in shipping, of course the investor is going to ask firm number 7, what is your shipping strategy? So there is that as well. There's a lot of internal competition within the industry. So I think unless the market recovers in the next year or 2 years very strongly, it'll still be one where private equity will be very active, and that may tail off. For example, private equity may be less active, say in product tankers and gas, where the market has started to recover and where the public markets are open, to the point that Anthony made. But in markets like crude, dry bulk, containers, where the public markets are not open, I think private equity will continue to flow into those segments.
Thank you. You have been on the early mover side with Euroseas. Do you have a view also on the market? Is that a first round of investments? Do you think it will continue in the future? It's, not for you necessarily, but with the shipping.
Well, the nature of private equity is to invest in assets and industries which are valued low compared to their historical trends. This is what's happening in shipping now. Therefore, I would say yes, that private equity has indeed an interest in the sector this period, and as long as we see these kind of valuations, yes, private equity will show interest. However, in order for them to produce the required returns that they usually want to see on paper, it might be a bit difficult in the time frame that they usually have. If they have the ability and the capacity and the patience to stay in the industry, I'm pretty sure that in today's values they are going to see very good returns on their investments.
And based on that, you trigger my next question, which is as private equity is private, so you don't necessarily know all the numbers of all the deals that are announced, but the feeling I was having from marketing gossip, let's say, was that initially private equity approached shipping with some numbers that were way out of the chart, at least from the way the ship owners were looking at these numbers. Do you think that this gap is now closing, that the learning curve has brought both ship owners and private equity closer? Do you think there is further room for more realignment in the parameters or the expectations, so in terms of tenure, of returns, of investment course? You probably did come close if you had the first deal.
Well, the private equity guys are really smart guys, and they read their homework before they do something, they move on something. We see them that they have improved their knowledge in the industry a lot, and they continue to do so. Indeed, at the beginning they couldn't understand many things that we were telling them, and vice versa, but right now we have a very, very good communication, and they really understand what's happening in the industry.
One thing I would like to say is I did my first private equity attempt, which was unsuccessful, in '99. At the time, it was a dot-com era in the States, and people were looking at 30+% returns. Also, shipping was, very much, I would say, a sort of very unique type of super cyclical industry. It wasn't down the fairway, as they say, meaning it wasn't kind of like a middle of the road type of investment. And also, the management, as much as we sometimes don't want to admit, was not particularly value additive in terms of value creation. It's more driven by the marketplace in general. Back then, let's not forget that the opportunity cost was very high because they could invest and make billions in internet startups. The interest rate environment, or the cost of capital, was completely different. Fast forward more than 10 years, and today the interest rate environment is such that an investment in a relatively, I would say we're not a stable industry, but at the same time we're an asset-backed industry that more or less is a relatively visible business model. A return of 17% or so is much more palatable to those funds as it was compared to 10 years ago.
I was going to say something very similar. Even at the beginning of this cycle, as Anthony mentioned, people were looking for 30% returns in a dot-com boom. In late 2009, early 2010, investors were again looking for 30% returns. But I think private equity, at least those that have been active in shipping, have stopped looking at it as shipping is a highly risky industry, therefore we need 30% returns, into one where their thinking is because the entry prices today are so attractive, meaning that you're pretty unlikely, if you invest in mainstream sectors where the supply-demand outlook is decent, you're pretty unlikely to lose money. In some cases, very unlikely to lose money. If you're very unlikely to lose money, well, it's pretty difficult to get a 30% return in that industry. So again, 15, 17%, especially in a low interest rate environment, especially when the prices of real estate are up, the prices of farmland are up, you can't get the sort of leveraged bank debt to buy casinos and hotels anymore. Shipping becomes quite attractive. at mid to high teens if it's very unlikely that you lose money.
You mentioned the magical word, leveraging. It became clear in the discussion we had the last 2 days, but it's nothing new, that banks, or most traditional shipping banks, are not necessarily eager to extend their balance sheet to shipping. 2 questions. I was speaking to a large private equity house recently, and they seem to be interested in extending not only equity but also debt themselves to shipping companies. So the first question is whether you see a trend developing there. And the second is, even if the private equity house itself doesn't do that, do you think that its contacts with the banking industry can allow smaller owners who don't have necessarily access to the banking system, improve this access, so find leverage via partnering with a private equity house?
I think it's mostly the hedge funds. I think it's mostly the hedge fund as opposed to the pure private equity funds that have exhibited an interest to provide debt financing. In general, I would say that the return requirements are sort of similar to what we mentioned before, so mid to upper teens. As a result of that, typically they have a significantly larger spread, closer to like 6-7%, and typically they have also some equity kickers. But yes, I think there will be funds providing this type of capital. I'm not so sure it's adequate to fill in the shortfall from the banks, although we all talk about the shortfall from the banks, but I see people having absolutely no problem ordering dozens of new buildings. So I hear about it, but I don't see it.
Debt is more difficult to come by for second-hand transactions than for new builds, which is not necessarily a positive for the industry overall. It's going to be a positive for those that are ordering fuel-efficient new builds, but may not be the best thing for the industry. For second-hand vessels, it is much more difficult to come by, and private equity in general is a user of project finance, non-recourse, asset-backed debt. So today, while large corporates can tap large shipping corporates can tap the traditional shipping banks for debt on quite attractive terms, private equity, although in many cases theoretically have a bigger balance sheet than some of these corporates, because they don't get corporate guarantees, they don't have access to that capital. The other trend that we expect to see but haven't seen yet is that the U.S. private equity firms that have very strong relationships with U.S. banks who have access to cheap, long-term U.S. dollar funding, the private equity firms should push their relationship banks in the U.S. to provide debt for shipping. We've been expecting this to happen, and we think it will, but to the best of our knowledge, it hasn't happened in size yet.
Sorry, just for you will answer, but do you understand why this has happened? Because I agree with you. I would expect these firms to to use their muscle to achieve that.
I don't have an answer for that, but I think it will.
It will happen.
I think it will
Yes.
happen. I'm pretty sure. Maybe you know that. Maybe you know it'll happen.
I'm just asking. Just a trivia.
As correctly Anthony said, these products are mostly developed by hedge funds rather than private equity firms. We as Euroseas have been approached from various firms offering such arrangements. However, I think that for companies that are healthy and have no imminent financing needs or are in distress, this is very expensive money. And it doesn't make any sense. Of course, there could be owners, rather small owners, I would say, which could take such risks and have the appetite to do such deals, but for us, at the time being, it sounds like very expensive money.
Certainly is. Paolo, you described a number of parameters about what private funds like, what private equity funds like, and what they don't like. But we do see private equity teaming up with fairly different kind of corporates, big, small, more structured, less structured. Do you think that this has to do with chemistry between the principal and the private equity fund, where for structure is disregarded in favor of this chemistry? Is another element that each private equity considers a different corporate structure better for their own needs? Why do you think this happens?
I think you almost answered my question for me. I think chemistry, with the private equity firms and hedge funds as well, but professional investors in general, chemistry can be quite important, because no matter what the business plan says, no matter what the documents say, how the working relationship will work legally, you can take the view that you're better off working with someone that you think you can work with, someone that you understand. We have seen a number of joint ventures between private equity or hedge funds or other investors and private ship owners, where it seems that to a significant extent the pairing was because the chemistry was there. Although that chemistry can take a while to manifest itself in a transaction, and I think that's one of the reasons that at this conference 2 years ago, I suspect, as other conferences in New York, London, everyone was saying, "Where's private equity? We were expecting private equity to come to save the industry, and these firms are doing nothing." Well, there's a reason for that. One is probably they saw that the market was going to get a lot worse before it would get better, is one. But two is take a long time to do their homework on the market, and take a long time to do their homework on the partners that they choose.
Right.
One thing I would say is that what we're seeing is that they need, I think, for the industry to create bigger, significantly bigger and more transparent entities. We're still a mom and pop industry. Most companies are small. To have a $1 billion equity market cap in the public markets, is in the U.S. is not even considered a small capitalization company. You have to be at least $5 billion. And in shipping, we don't have even these examples. I think, we have a lot of public companies that have sort of, because of the compression in the valuations, have sort of entered a point where they are sort of in no man's land, the sub $100 million, ultra nano cap category. And I mention this why? Because in the US, I think the message I would like to convey is that there is huge amount of capital. It's almost easier to raise 500 million as opposed to 30 million. We've seen the recent example of Costa Mare. Also for larger, more well-capitalized entities, public or private for that matter, talking about debt, there is the so-called term loan market. Imagine you can borrow 50 or 60% of asset values effectively with no maintenance covenants. Okay, you'll pay bigger spread, but there are many companies in the low single B rating environment, I would even say in the upper triple C rating environment in the US, that are borrowing money in the term loan market where you can literally borrow billions of dollars. So I think the problem here that we have is that the shipping companies usually, for the most part, are very, very small to attract this kind of capital.
Well, that's a good point, and I think you're right. The structures of most shipping companies are SME structures, Greek SME structures. So it's there are many pressures many factors that are pressing towards more corporatized environment. We've seen that in the past, and it hasn't happened. It hasn't led to more corporatization. It seems to be doing now, but we'll have to see. I've been wrong many times in the past, predicting that it will work towards corporatization, and it hasn't. So let's see. So you wanted to add something to that?
One of the topics that you gave us to study was the key ingredients for successful cooperation. And chemistry was my first point. I mean, you can't start a marriage without a good chemistry.
Yes.
So I would say that it's a very, very important thing that both parties have good chemistry.
But I guess the follow-up question on that is, on the side of and especially with the point that made, on the side of the shipping company, chemistry is a fairly steady element, in the sense that you have the principal who has his views, whatever are these views, and the company runs under his mantra. On the private equity, the person expressing the chemistry is a manager. It's an employee, in a sense. I would put it more bluntly. So, if this person leaves this private equity firm, does that mean that the rest of the private equity will continue to have the same good chemistry? Because we're talking about a partnership that isn't supposed to last 3 months or 6 months. We're talking about 5 years, I assume, on average. So, if chemistry is the key element, how do you make sure that this stands the test of time?
Well, in our case, what you just described did happen. I mean, one of the guys that was actually leading one of the private equity parties left.
Yes.
Just after we announced our cooperation. The remaining of the team stayed, and
it worked well.
It worked, yeah, and it worked fine. I mean, we had good chemistry with all the guys. But what you said could happen. I mean, you could have a change, and the new guy that comes in could not be as cooperative, or you don't have the same ideas, or the chemistry is not there. This is a fact. It could happen. It didn't happen in our case, no.
Well, thank God. Shall I open up to the audience? Any questions regarding private equity? Caroline, how are we doing time-wise? No answer. Okay. If that is all, then I will have to thank you, gentlemen.
I thought Mr. Kambanis wanted to start his own private equity.
I will pass the floor to Mr. Kambanis, who wants to make an announcement before our lunchtime. Gentlemen, thank you very much for your insights and your feedback. And the floor is yours, Mr. Kambanis.
Thank you. Is this working? Yeah.
Yes, it is.
So, I guess because we're paying for lunch, I get 1 more minute to speak. And I'd like to bring to your attention the Sustainable Shipping Initiative. We have brochures at our table outside, and I encourage you just to pick up one. About 20 companies, including BP, Bunge, Cargill, Maersk, Wärtsilä, and others, got together. Lloyd and 10 are members of this organization, and the idea is to make shipping more sustainable and to reduce the consumption. We specifically focused on retrofitting the old fleet to make something of the existing fleet and make it more sustainable and more fuel efficient. And we had an event on Wednesday where we invited ship owners, and we still will be inviting others to join a pilot that we will be monitoring to see from these retrofits how much benefit they indeed do get. And it's a great initiative to know about, and that's what I'd like to bring to your attention.
And thank you very much for doing so. And thank you very much for sponsoring the lunch we're going to have in a moment's time. In between, if I may summarize what I think we learned in the last couple of days. As I said, the global economy is not out of the woods yet, but it's not in the depth of crisis we had a few years ago. Shipping markets will probably remain challenged for a while, with a few bright exceptions, for example, some segments of the offshore market. The banking system in the West is and will be focusing on what it, or rather its regulators, perceive as quality deals. Balance of credit demands to be selectively covered by Asian newcomers in terms of debt. The banking system, in terms of regulatory and accounting framework, will shape its reaction based on these two elements. And the white knight, represented by private equity, is probably still marching towards saving shipping. And although obviously there are some key criteria that need to be met for it to work. Thank you very much for spending 2 days with us. I hope we all leave this room wiser than before. Don't forget your evaluation forms. Caroline, I see you walking towards you. I'm sure you want to make a couple of comments. So the floor is yours.
Just to say thank you very much indeed for being here across the 2 days. We changed the schedule slightly to let you escape earlier on a Friday afternoon. Deloitte are very kindly sponsoring today's lunch, so do join us for lunch. I will collect the evaluation forms from the desks after you've left the room, so just leave the completed forms on the desk and I'll collect those from you. Thank you very much indeed again to our sponsors, to Deloitte for sponsoring today's lunch, to Chapos Energy Navigation for kindly sponsoring yesterday's lunch, and also for the support of Marshall Islands and Marine Tours as well. We are grateful for your support. Of course, all the speakers have given their time and expertise. We've had controversial discussion during panels as well, and I think it's been extremely informative. Dimitri, as I said yesterday, I was after Dimitri for years to get him to chair this conference. He finally agreed, and it's been a pleasure to be able to include his participation. I think he's been a very good chairman, and I think he deserves a round of applause.